biggest surprise, I think, out of the Fed is that the divide inside the Fed is growing. Why is that?
Well, you know, Sarah, first of all, we have 17 folks around the table, and the Fed has a long tradition of candid, frank discussion about the economy. I think it's a strength of our system. Chair Powell indicated that the other day. I think what it indicates is the economy's in a good place, but in the 11th year of expansion, there are also some risks. And the committee is looking at those risks and looking at the baseline outlook and making a judgment on where to set policy. But we think that is healthy. And where the committee is united is our common goal, which is to sustain maximum employment and price stability, and that's important.
But it's a little confusing as far as the outlook, where 7 members say there'll be another cut this year, and 10 members say stand pat or raise rates. What's the market supposed to take away from that?
Well, I think what the market's supposed to take away from that is that there's a range of views on the committee right now about the appropriate level of rates to sustain expansion. We all agree that we're in a good place, and we all agree that the momentum is solid, but there's a range of views. I think it really comes down also to risk management. As Chair Powell said the other day, we think of the adjustment we made this week and in July as providing some insurance against some downside risk to a favorable outlook.
So 2 insurance cuts. How much insurance do you need to buy this economy?
Well, of course, and I'm going to say probably what you expect. We're going to take this meeting by meeting. We're not on a preset course. And as we get into the October meeting and beyond, we'll take it on a case-by-case basis. But again, we will act as appropriate to sustain a strong labor market and price stability.
One of the two dissenters were out this morning. St. Louis Fed President James Bullard says you need to be more aggressive. He's in favor of 50 basis point cuts, saying that he believes lowering the target range for the Fed funds rate by that amount at this time would provide insurance against further declines in expected inflation and a slowing economy subject to elevated downside risks. Why not do more?
Well, again, Jim expressed that view, and we understand that. Of course, there are views on the other side as well from the other dissenters. But I think the center of gravity, clearly the center of gravity on the committee, is that the second adjustment was appropriate. And again, going into October and beyond, we'll go one meeting at a time.
Yeah, Rosengren also out this morning saying that this move risks further inflating the prices of risky assets and encouraging households and firms to take on too much leverage. Why is he wrong?
Well, we look at financial stability on a regular basis on the committee, and we assess financial stability. And right now, we as a committee do not see those elevated risks. We're very attentive to that. We're very focused on that. I think President Rosengren was making a general point about past situations. But I think where we are right now, the committee thinks that we're in a good place.
How likely is it that we just saw the final cut of the year?
I don't want to put probabilities on it. Again, as the summary of economic projections indicated, 7 participants thought that under their baseline view that a further adjustment would be appropriate policy. But again, that's not a commitment. We didn't vote on it. We'll take it on a case-by-case basis. But again, we're going to be very attentive to the data, not only the baseline data, but the risk to the outlook.
So risk to the outlook, how much depends on what happens between the U.S. and China on trade?
I think that's an element of it. Let me talk more broadly, Sarah, about the risk. So we clearly have a slowing global economy. The OECD just this week marked down its global outlook. Obviously, the U.S.-China relationship is important, but there's a broader global slowdown. There's a slowdown in global capital spending, in global manufacturing, and there are also some pretty important disinflationary forces. But obviously, U.S. and China are part of that, and we referred to trade policy uncertainty as a factor in this, but it's not the only factor.
So global growth slowdown, trade policy uncertainty, and disinflationary pressures. Are those all getting worse or better right now?
Well, certainly relative to where we were at the beginning of the year, I think they've been getting worse. And certainly, I think the global economy in terms of projections for global growth have been marked down since July. For example, the OECD downgraded its view relative to this summer. So I think in terms of global growth, it's getting worse. In terms of global trade and global investment, it's been pretty soft for a while now.
Have you been surprised to see the resilience of the U.S. economy in the face of a worsening global economy?
You know, Sarah, I'm not surprised in the sense that the U.S. economy is a resilient economy. You know, we have really been the star pupil in the class of the global economy for some time now with, you know, very strong labor market, strong growth, and low inflation. And I think a lot of other countries in the world would envy where we are right now. So no, I'm not surprised by the resilience, but we don't take it for granted either. So that's why I think the risk management approach that Chair Powell outlined is the appropriate place to be right now.